Here are 7 tips for buying gold. Gold prices can be volatile and even decline from time to time, but the metal has proven to maintain its value over the long term. In general, movements in the price of gold depend on many factors. Price is affected by supply, demand, and investor perceptions. Because the metal is often used to hedge against inflation, the pace of inflation and market expectations for future inflation levels can have a strong effect on gold prices, both positively and negatively. In addition, deteriorating economic conditions may sometimes bolster gold prices because the metal is seen as a relatively safe investment in difficult times. How to invest in gold? There are many vehicles for adding investment exposure to gold. It is possible to own the physical metal in forms such as bullion, coins, or jewelry, although storing and insuring physical gold assets can be costly. Other possibilities include investing in a gold exchange-traded fund, ETF, or buying shares in mining companies that engage in the extraction and production of the precious metal. The bottom line, many investors choose gold as an important part of a diversified investment portfolio because its price increases in response to events that cause the value of paper investments, such as stocks and bonds, to decline. Although the price of gold can be volatile in the short term, it always has maintained its value over the long term. Through the years, gold has served as a hedge against inflation and the erosion of major currencies, and thus is an investment well worth considering. Words of caution. Gold jewelry. About 49% of all global gold production is used to make jewelry. As the world's population and wealth are growing each year, demand for gold used in jewelry production is expected to increase over time. On the other hand, gold jewelry buyers are shown to be somewhat price-sensitive, buying less if the price rises quickly. Buyers should be aware that buying fine jewelry at retail prices involves a substantial markup to the seller, perhaps as much as 300% or more over the underlying value of the gold content. Better jewelry bargains may be found at estate sales and auctions. The advantage of buying jewelry this way is that there is no retail markup. The disadvantage is the time spent searching for valuable pieces. Nevertheless, jewelry ownership provides an enjoyable way to own gold, even if it is not the most profitable from an investment standpoint. As an art form, gold jewelry is beautiful. As an investment, it is not attractive, unless you are the jeweler. Mutual funds and exchange-traded funds, ETFs, are generally the easiest and safest ways to invest in gold. Each share of these securities represents a fixed amount of gold, and an investor can easily buy or sell these funds in his brokerage account or retirement account. Gold mutual funds and ETFs are a good choice for beginning investors because of their low cost and low minimum investment requirements. Gold is also seen as a good investment during a recession because gold historically has shown a low correlation with other types of investment choices. Many investors include gold in their portfolios as a buffer against potential economic downturns. Also, gold prices often increase when bond yields decline. While there may be benefits to investing in gold in a recessionary environment, its effectiveness during a recession or any other stage of the economic cycle will depend on how well it fits into an investor's overall investment strategy. Larger investors wishing to have direct exposure to the price of gold may prefer to invest in gold directly through bullion. There is also a level of comfort found in owning a physical asset instead of simply a piece of paper. The downside to this approach is the slight premium to the value of gold paid on the initial purchase, as well as the storage costs. For investors who are a bit more aggressive, futures and options will certainly be a more appropriate choice. In any event, let the buyer beware. These investments are derivatives of gold's price, and they can experience sharp moves up and down, especially when done on margin. On the other hand, futures are probably the most efficient way to invest in gold, except for the fact that contracts must be rolled over periodically as they expire. The idea that jewelry is an investment is a popular perception, but it is misguided. There is too much of a premium between the price of most jewelry and the value of its gold content for it to be considered a good investment. Instead, the average gold investor should consider gold-oriented mutual funds and ETFs. These securities provide an easier and safer way to invest in gold. Gold mining and bullion. While mining company share prices are certainly influenced by the ups and downs of the price of gold, they are also subject to factors apart from the price of gold, such as bad management decisions or social unrest in the many countries where they operate. The same thing is true for exchange-traded funds or ETFs that allow investors to hold multiple mining companies under a single ticker symbol. These funds provide diversification among several companies, but they still do not track the spot price of gold like a gold bar would. Gold-backed exchange-traded funds, such as SPDR Gold Shares, GLD, offer a hybrid between investing in a stock and investing in physical gold. These funds are traded on an exchange like any other ETF, but instead of owning stocks, they are backed by bullion held in vaults, with each share representing exposure to a fractional ownership interest. Because of that, they track the spot price of gold more closely than stocks. Investors who want to buy physical gold can turn to online bullion dealers, pawn shops, as well as some banks and individuals. Physical gold is often called bullion, a term that encompasses bars, coins, and rounds, but not jewelry. Rounds are coin-like pieces of metal made by private mints that don't have value as currency. Gold coins from government mints do have a face value. You could, in theory, use an American gold eagle to buy something up to the coin's $50 face value. However, that would be foolish as the ounce of gold the coin contains is worth far more than $50. Coins also have a collectible value based on their rarity, which can help insulate their value from downturns in the spot price of gold. However, that can also mean you pay a substantial premium over the spot price of the metal. Here are 7 tips following when buying gold bullion, that is, physical gold, at lower costs. If you decide that investing in physical gold is the right move for you, here are some things to keep in mind. Compare prices. Shop around to compare prices from various dealers, including premiums above the spot price of gold. When buying gold, look for premiums of 3% or lower over spot price. The spot price is the price at which buyers and sellers are willing to trade gold at a particular time, or the price at which gold is presently trading on a commodities exchange. That is distinguished from a futures price, the price at which traders agree to buy and sell at some future date. Gold dealers typically charge a markup from the precious metal's spot price when you buy or sell it. In some cases, the markup can be 10% or more of the gold's value. Find a reputable dealer. There are numerous reputable dealers, but scams are commonly committed by fraudulent gold dealers. From working with pushy salespeople to falling victim to scams, navigating the world of buying and selling gold can be sketchy. Sellers can inflate their product's value or use persuasion tactics to create a sense of urgency to buy immediately. Doing some homework ahead of time can help you avoid a bad investment. It could be difficult to determine gold purity on your own. Buy in bulk. Dealers often offer lower premiums per ounce for larger purchases, so buying a more substantial amount can save money in the long run. Choose bars over coins. Gold bars generally have lower premiums than coins due to the collectible and design value of coins. Find out what fees might apply. Gold dealers typically charge more than gold's spot price. This premium typically consists of a dealer's fee and manufacturing and shipping charges. There are many retailers that allow you to buy gold online and feature a variety of gold coins, rounds, and bars. Sellers will usually mark up the price of physical gold from its current spot price, so be prepared to pay more than the actual value. Avoid rare coins. Unless you're a numismatic expert, stick to bullion products to prevent paying for the rarity or collectible value. Standard gold bullion bars are generally easier to identify and have standardized hallmarks and engravings. Understand buyback policies, if any. Some dealers offer a buyback policy at or near spot prices, which can add value and assurance. The cons of buying gold bullion: you may need a secure vault or insurance to protect it. Find secure storage. People joke about burying gold for a reason. It's valuable, and because it's a physical commodity, people may try to steal it. It is important to anticipate storing your gold somewhere safe, whether that is a literal safe or a safety deposit box at a bank. Storing gold safely can get expensive depending on their size. Consider purchasing insurance. Insurance is an additional cost of owning physical gold. If you purchase insurance, be sure your policy covers the exact type of asset you have. Understand that your investment is illiquid. Unlike gold stocks and funds, it might be difficult to resell physical gold. Pawn shops aren't known for their fair pricing, and if you sell your gold back to a dealer, you'll likely sell for below the gold spot price. Thank you for watching. Remember, always do your research and consult with financial professionals before making investment decisions. If you found this video helpful, give it a thumbs up and don't forget to subscribe. If you leave a message below, I will respond. You also might like to check out my pages on Facebook and Rumble, the Global Macro Digest R, and see my books that are featured there.